Welcome one and all to yet another interesting content in our channel Know Your Industry. If you have been following us in the last few videos, you have seen that we have covered different types of life insurance that you can go for. We have been covering the general insurance path, and we have been going through different types of or different lines of business within general insurance. Today, we are going to look at different important performance indicators in this industry, that is insurance, and we will be precisely looking at the different types of sales KPIs, the claims and operational KPIs, and the different financial KPIs that we have, and we go through while we go through different processes and use cases within the insurance industry. Without further ado, we would start off with the sales KPIs we'd go through today. The first one being quote rate, right? So quote rate, as we see here, is the total number of quotes that are offered versus or by the total number of leads which are contacted, right? So that means that, say for example, agent, if you consider an insurance agent, he or she say goes through or contacts or gains say X number of leads in a month, right? So say for example, he or she gains 100 leads in a month, 100 prospective clients in a month. Out of 100 prospective clients, number of quotes which are shared with X number of clients. So say for example, out of 100, if you have shared quotes with 50 customers, right? We have spoken with them, we have understand their needs, and then we have written a policy and we have shared the quote with the customer that this is your policy, this will be your coverage. This is the premium that you have to pay, and this is what we call the quote, right, for a particular line of business. So if you have shared 50 out of 100, so it will be 50%, right? The quote rate will be 50%. So what we understand from this is that what percentage of customers we are converting from a cold call to a hot lead, right? So that is what quote rate gives us. The second important KPI is bind rate, right? So this is one step above quote rate. So say for example, out of our 100 prospective customers, we have shared quote with 50 customers. But within the 50 customers, finally 25 customers have liked our quote and they want to go ahead with us, right, as an insurance company. So in that case, 25 policies have been actually sold out of 50 quotes which were shared, right? So again, in that case, the bind rate is 50%. So that is what bind rates tell us, right? Number of policies finally sold as a share of the total quotes which were shared. Retention rate, as you understand from the name, is number of customers retained in X period by total number of customers that you have in that period, right? So this is a simple or a more generic KPI, I would say, which is there across industries, not anything specific to insurance industry, but within insurance industry, this is also one of the important KPIs, right? And then policies in force by agent. This is also important, that number of policies in force by total number of agents that you have, right? So in force here means number of policies which are active, right? So the insurance technical term is in force, but you can understand it by saying that number of policies which are active at any specific point of time versus total number of agents that you have. So we can understand from this KPI any specific department of a company, the operational efficiency of the organization is, or the department is easily understood, that how well you are utilizing your agents or how well you are utilizing your different forces today to sell your policies, right? Because today it's not only agents who sells policies, everything has become online. So number of websites or number of ads or amount of money you are spending in your marketing, all those things are, you can customize those things, or you can look at that how efficiently you are spending your resources from this KPI. So the next one we are looking at is underwriting cycle time, right? This is also very important. So if we don't know what is underwriting, so underwriting means that, say for example, when you gain the initial set of information from the prospective customer, and then you have to share the quote, you go through the underwriting process. You, in the sense, the insurance company goes through the underwriting process where based on the different information that we have gathered. So say for example you want to buy a property policy, right? So you have shared as a customer, you have shared information like, this is the age of my property, this is where the property lies, my flat is on 13th floor, the size of my flat is this much, and all these information, right? Now based on these kind of information and based on certain business rules which are there in the insurance company end, the insurance company will try to calculate the amount of risk which is involved in covering the policy, right? Or basically in selling the policy to this customer, right? Based on the age of the house, obviously the risk will add, right? Or increase, right? The older is the house, the more is the risk. So similarly, there will be other business rules as well, and based on this combination of business rules, you will finally come up with the premium amount, right, that the customer has to pay to get the entire coverage of the property. So this is underwriting, right? Now, what do we mean by underwriting cycle time? So this means that, so if you are say working on 10 policies in a month, and each of the policy you are on an average taking say 10 days, so your underwriting cycle time is basically 10 days. So what is this 10 days? This 10 days is the time between your prospective customer reaching out to you saying that I'm interested in a policy, can you share me a quote, to the time that you have done all these calculations in terms of understanding the risk and doing the calculation of the premium, etc., and sharing the final quote with the customer, right? So this is the underwriting cycle time. So what is happening is over the years, as technology is becoming better day by day, this time frame is even increasing, right? Decreasing slowly, right? So previously at one point of time it used to be say a week, right, or more than a week, right? And from there it has come down to few days, and today even few companies are giving it within hours, right, or within 2-3 hours, right? You have raised a request, within 2 hours you are getting it in your email saying that okay, so this is your quote, this is what you need to pay, and this is the amount of coverage that you will get based on the information that you have furnished with us. So that is underwriting cycle time. And the last one in the sales KPIs list we'll look at is average premium per policy, right? So this is also important from the company policy, from the insurance company policy, that per policy how much is the premium that you are generating. This tells you that so how well is your incoming finances, how much profit you will make at the end of the day versus every policy. So that's the average premium per policy, right? Obviously your policy should not be also overpriced. So if this is too much, this can also say that your policies are overpriced, and maybe customers will go to your competitors, right? So you should also benchmark this with the industry and see that whether your average premium per policy should not be also too high compared to the median value, but it also should not be too low, right? It should not be giving policies at a price which is less compared to most of your customers. So these are the sales KPIs we wanted to look at today. Now we would go to the claims and operations KPIs, and the most important of them is claims ratio, right? So that says that the total premium received, so say for example if the total amount of premium received in a certain period is 100 rupees, out of which the number of claims received is 5, right? So what does that tell you? That it tells you that so premium received means what? That number of say amount of policies that you have sold, right? So out of the number of policies that you have sold, if the number of claims received is too high, that means that whatever premium you have received, it won't be enough for you to service the claims, right? So there should be a good balance between number of claims that you are receiving versus the total premium that you have received, right? So that tells you that how well you are doing the underwriting and you are understanding the risk, and you are not taking, as an insurance company, you're not selling policies which entails too much of risk, that the customer is doing a lot of claims, but the premium that you are getting is not enough for you to service the claim. In that case, you will go into a loss, right? Versus if this ratio is low, right, number of claims received is low compared to total premium received, then as an insurance company, you're in a sweet spot, right? That the premium you are getting in certain intervals is high compared to the number of claims that you are receiving. The second important KPI we're looking at is average claim settlement time, right? So this is similar to the underwriting cycle time that we have seen in the previous slide, right? So underwriting cycle time obviously should not be again too high, because otherwise I would lose interest in you, and I may be asking quote from multiple insurance companies. As if some companies gives me within 1 day and you share with me after 3 days, in that case I've already sold to some other company, right? Similarly, the claim settlement time is also very, very, very important, right, for an insurance company. So this is the actual proof that how well an insurance company is run, because it is well known, and everybody says that an insurance company is known by how well and how fast it settles its claims, right? So if the claim settlement time is low, then obviously you want to stick to the company, and you would also refer this insurance company to multiple of your friends and family, right? So this is also important from an insurance company perspective. The third one we would look at here is claims frequency, right? So again, claims frequency is somewhat related to claims ratio. Total claims in X days versus X days, right? So if you again see that the claims frequency is increasing slowly in a particular line of business or in a particular geography, you have to understand that whether there are some frauds happening, right? Whether some of these claims which are increasing are fraud claims, or if these are true claims. In that case, you have to see that whether you are sharing policies with the right set of people, right, or with the right set of organizations, right? Because that would again lead to the amount of money you are shelling off through settlement of the claims. If that becomes high compared to, or more compared to, the amount of premium that you're receiving, again you will go into a red zone, right? So hence claims frequency, or the basically the how the claims frequency increasing or decreasing day by day, at least that is very important from an insurance company perspective. The next one is average cost per claim. So again, this is purely financial thing, but I've still put it within this because we are talking about different claims here. So total cost incurred in servicing X claims versus X claims, right? So when I say total cost, that means the amount that we will be paying off as purely as a claim, plus any other cost which is involved here, right? So other costs will be, so in terms of your operational costs, right? So say for example, if any court cases have happened, and you have to shell off some money to settle the court case, right? Or any other amount that you have spent as an insurance company. So those costs will also be added along with the claim cost, and that will be divided by the number of claims that you are considering in a certain period, and then you'll come up with the average cost per claim. So again, as indirectionally, if the average cost per claim increases, that is a red flag, and you have to see that why is it increasing, right? Is it like I am spending too much money apart from the claim which is raised and which I should have paid, and then I have to devise certain ways to reduce those costs, right? Is it that can I reduce the court cases cost in any way, or can I reduce my normal adjustment costs or operational adjustment costs in any way, right? So I have to look into those aspects, right, as an insurance company. Claim settlement ratio, right? Number of claims settled in X period versus number of claims received in X time period, right? So this is again an operational KPI which tells that how good is your team in settling the claims in quickly, right, within the expected time frame, right? So at any point of time, if I look into this KPI and I see that number of claims settled is high, or say that this percentage is about, say, more than 60-70%, then I would say then this is good, right? That you don't have bottlenecks or operational bottlenecks in your process in settling the claim. But any point of time, if this percentage is less than 50%, I have to understand that no, we need to do certain changes. I need to look at the data, mine the data properly, and then have to see that how can I speed up the process so that the number of claims get settled more in a certain period of time, right? The next thing we are looking at is claims leakage, right? What does claims leakage mean? So claims leakage will only come into the picture when I am paying more compared to what I should have paid as an insurance company. So the formula is actual claim payment made minus amount that should have been paid under the terms of the policy, right? So say for example, for a claim is raised of 100 rupees, right? But somehow I have ended up paying 120 rupees, right? How I have ended up paying that, say for example, under the terms of the policy, in a particular scenario 100 rupees I should have paid, but there was a, say, adjudication, and from the court it was, and the person who has who was insured, he has raised it and say he has won the court case, and the court has told that the insurance company has to pay 120 rupees to this person, right? So in that case, the insurance company have to end up paying 120 rupees to this person, right? So in that case, this 20 rupees is the leakage. 20 rupees is the additional amount that I have paid, which I did not think that I have to pay from my pocket, right, as an insurance company. Hence, 20 rupees is the claims leakage. Now we would look at the third type, which is the financial KPIs. The important financial KPI we are looking at now is the expense ratio, right? Now all these we would look at purely at a dollar or a rupee percentage, right? So total premium earned in X period. So total underwriting expenses in X period versus total premium earned in X period, right? So total underwriting expenses, mind you. So for doing underwriting, whatever the total amount that you are spending in X period versus total premium you have earned in X period is the expense ratio, right? So basically for doing the underwriting part, what is the expense that you are having, right, versus the total premium. So this only is the expense ratio. We have to understand it along with loss ratio. That's why I've opened it up. So what does loss ratio means? Loss ratio is the total cost that you are paying, right, which is the claims paid plus the loss adjustment expenses, right? So for doing any adjustment because of n X number of reasons, if you are doing any expense plus the claim amount that you are paying out from your pocket versus total premium earned is the loss ratio, right? So although it's not a loss for me, right, from insurance company, because I have to pay my claims, right, whatever the customer is asking for. So that's my business. Plus the loss, which is, but the adjustment expenses is maybe the loss because there is certain additional amount that the insurance companies has to pay, right, for doing some adjustments, as I was saying, because of some adjudication or because of doing some research in certain cases. So for doing the research or for doing this additional work, I am doing some additional expenses. So that will be added to the claims paid and divided by the total premium. I'll get the loss ratio. Simple. Now, you must be thinking that in the top ratio we are talking about underwriting, in the below ratio we are talking about claims paid plus additional. So these three are my total cost, right, that I as an insurance company I am spending in the entire process. So if I add these three, then I'll come to combined ratio, right, which is this one. So combined ratio, if you see, is expense ratio plus loss ratio. And together, if combined ratio is less than 100% or less than 1, then my the cost that I am then basically I am in a positive then my cost is less than the premium that I am receiving. But if my combined ratio is greater than 1 or greater than 100%, that means my cost is greater than the premium that I am receiving, right? In that case, I am in loss. So if combined ratio is less than 1, I am in profit. I as an insurance company, I am in profit. Otherwise, I am in loss, right? So that way you need to understand what is combined ratio, and you need to understand individually what is loss ratio and expense ratio. Now we will come to this one, which is cost per bind, right? By vertical, right? So this is per bind. I am saying that what is the total expenses of X policy binding, right? So again, so what is the total expense? So So here, I mean, this is mostly look at by vertical. That's why I'm giving by vertical. So say by vertical means by line of business, right? So within life insurance, what is the total expenses I have done for binding, means for selling X policies by X policies, right? Again, this is the total cost, which is a sum of the expense cost and the loss cost, which I have explained here, right? Now the next ratio here, it says about average policy size, right? So this is a totally different thing, right? So policy size, and then obviously again I was telling that in anything here, all the KPIs will understand through dollar amount or rupees amount, right? So policy size means so the coverage amount for the policy. So say for example I'm covering 1 lakh for a medical policy that I've sold, right, as an insurance company. So the policy size is 1 lakh. So similarly, I have sold 10 policies, say something of 50,000, something of 2 lakh, blah, blah, blah. So if I take the average of the policy size, that is what it is, right? So 10 policies, something is 50,000, 1 lakh, 2 lakh. I'll do the sum, I'll divide by 10 and I'll get the average policy size of say 1 lakh, right? So this tells me that what ticket size policies I am selling more, right, as a department or as an organization. So if it is on the lower side, then I need to understand that I need to go out into the market. I need to tap say if I am in the smaller size, I need to tap mid-level customers or high-level customers more, right, to increase the size of my organization or the scale of my organization. So that's how we read this KPI, average policy size. And the last one we will look at today is the reinsurance seeded percentage, right? So this is all these we were talking about insurance or insurance department of the organization. The last one we are looking at a reinsurance seeded percentage. So just to let you know, if somebody doesn't know what is a reinsurance, so even insurance companies also have insurance companies. So what does that mean? That if I have a risk, I want to share my risk with the insurance company, and that's why I buy a policy, right? So I pay certain amount to the insurance company. On return, insurance company gives me the coverage. Now, say for example, insurance company is this insurance company with which I as a customer I am interacting. This insurance company X or XYZ cannot cover me totally, right? Doesn't have the fund to cover me totally. This company also needs help from somebody to give me the entire coverage. So say for example, I need 100 rupees from the insurance company XYZ. Insurance company can do the coverage of 70 rupees. But 30 rupees here, this company doesn't have. So this 30 rupees, this insurance company has to take from some other insurance company. So that other insurance company, we call it as a reinsurance company, right, in the insurance world. So that other insurance company is basically a reinsurance company. Now, what this percentage is saying is reinsurance seeded percentage. This says that the risk coverage passed on to the reinsurance company versus total risk coverage required. So what is the example that I took? That I need 100 rupees coverage from the insurance company. So my denominator here is rupees 100. What is the numerator here? Risk coverage passed on to the reinsurance company. So what is the risk coverage passed on to the reinsurance company in this case? It is that 30 rupees, which the insurance company won't be able to pay me, and then hence that portion of the risk the insurance company is passing on to the reinsurance company. Hence we are saying here that, so this in this case 30 by 100, that is 30 percentage, is the reinsurance seeded percentage, right? So this is also very important to understand that for an insurance company, normally based on again line of business or based on a certain period of time, what is the reinsurance seeded percentage that is going, right? Based on that, so this company or insurance company has to tie up with multiple reinsurance companies, or based on that I can tie up with 1 or 2 companies, and how much of help do I need from other insurance companies. All these things can be gauged, can be understood with the help of this KPI, right? So these are the financial KPIs that we looked at. So that's all that we wanted to look at today. So we looked at different types of sales KPIs, financial KPIs, and claims and operational KPIs in the insurance industry. If you have any question regarding any of the things we went through, I would request you to put a comment in this video. Thank you for listening in. In the upcoming videos, we would intend to cover a few other topics in the insurance industry. Thank you.